Fed is tightening monetary policy. The war in Ukraine continues. And here to talk with us about it is Dan Kern from TFC Financial. Dan, welcome.
Thanks. It's good to be here.
It's great to have you here, and we're eager to have you walk us through your current view of current events.
There's certainly no shortage of things going on. Why don't we start with the Fed? The Fed really talked tough last week. They communicated that inflation and getting inflation down is job one. Inflation is clearly ahead of employment among the Fed's concerns. I think the Fed has a tough balancing act politically, given the high inflation prints and it's really slower than expected healing of supply chains and labor markets. I look at this and I say it was an interesting press conference with Fed Chair Jay Powell. It seemed like every time he said the phrase "strong economy," the equity markets seemed to bounce. And he took great pains to talk about how strong the economy is and how strong the labor market is. The other, I think, telling thing from the press conference was he mentioned that there are 1.7 job openings per every unemployed person. And he said that several times. And so I think the Fed has positioned itself to raise rates 7 times this year, with getting to a Fed funds rate of nearly 2% by year end. But I think Fed Chair Powell has left himself a lot of room to adapt their plan depending on what happens from a data perspective. And I think there are several things that could happen that could cause the Fed to slow the pace of tightening. I think one would be if we have slowing growth that gets caused by spillovers from the war in Ukraine or COVID outbreaks in China. Those are 2 areas in which the economic growth path could really be compromised. The second is if we continue to see healing of the supply chain bottlenecks that have really afflicted us over the last couple of years, and if we see a follow through in terms of shifts of goods demand to services demand. That could also help ease the inflation picture. And then lastly, but probably most importantly, rising labor participation. We had somewhere in the neighborhood of 8 million people leave the workforce, whether it's retirements, people staying home to care for family members, people afraid to work because of COVID. The more of those people that come off the sidelines, the more likely it is that gap between job seekers and job openings narrows. And that would take the wage price spiral concerns off the table. I think there's a lot of fear that we're going to return to the 1970s and have this wage inflation baked into expectations, and that feeds into prices in a very uncomfortable spiral. I think Powell is taking great pains to show the investment world that the Fed will keep that from happening. He didn't want to admit that the Fed's behind the curve, but the Fed's behind the curve. And so tightening is definitely necessary. The other thing that I think was really interesting was that Powell really seemed anxious to talk more about the balance sheet normalization plans of the Fed. He wasn't ready to talk in details, but I had this impression of like him being a big kid who really wanted to talk about the Fed's plans to normalize the balance sheet. So that tells me that after the May meeting that they'll announce balance sheet normalization in the May meeting and start reducing the size of the Fed's massive balance sheet shortly thereafter.
Right, and that would be no small task, right? And the market's been waiting for how they plan to do that too, right?
It'll be very interesting. I think the stock market reacted very positively to Powell's words about the economy. The bond market reacted really very differently, and I think the bond market moves reflect some fear that the Fed is going to make a policy mistake. And I think it bears watching. The yield curve flattened a lot where in part of the yield curve we're inverted, and yield curve inversions typically have been a signal that a recession is coming. We're not there yet in the part of the yield curve that I pay the most attention to, but it definitely bears watching.
Right.
Eventually, the stock market and the bond market will probably reconcile to one another. But I think we all have to stay tuned to see what the data tells us about which market is right and which one is wrong.
Right. So Ukraine is also on your mind these days?
Yeah, and Ukraine is a humanitarian tragedy, really, no matter what happens from here. But certainly, Ukraine is another risk for the markets. It's been interesting to see what's happened there. I never would have expected the unity that we've seen from the Western world. And Olaf Scholz in Germany, Germany has had an unfortunate codependent relationship with Russia for quite some time. And for Scholz to say, yes, we're going to spend more on defense, we're going to support Ukraine with weapons, we're going to suspend Nord Stream 2 potentially permanently. For him as the leader of a very fragile coalition government to really break with a long stretch of partnership with Russia, was really a big and unexpected event. What I worry about with Ukraine is that the longer the war lasts, the greater the economic impact on Europe and the humanitarian impact. There is a much higher risk of recession in Europe now because of the war, and the longer that the war lasts, the worse that recession might be. The codependency between Russia and Europe, particularly with regard to natural gas, that's not going to get fixed right away. And so that's a long-term process to cure that codependency. I also worry about the risk of having an authoritarian Putin backed against the wall. The market has a tough time discounting low probability but high impact scenarios. And I worry that if Putin's back is against the wall, that he will use tactical nuclear weapons or chemical weapons. And certainly in human terms, that would be horrible. But in market terms, that's not something that's in market prices today. And so it's hard to talk about something that's such a humanitarian risk and then put it in simple market terms. But in doing what we do, we have to think about the market implications of different scenarios. And I worry about that. And I think we need to, in the West, figure out what the exit ramp is for this conflict and how we can contribute to an exit ramp that helps the Ukrainian people, but also helps the Russian people who are suffering through this as well.
Yeah. So all that leads to the question that's on everyone's mind: what should I do with my portfolio given the Fed tightening and what's going on in Ukraine?
So I think that the fog of uncertainty is about as thick as I've seen it in a very long time. And I think in an uncertain environment, balance is really important, especially for retirement investors. I think it's very important to have a good, stable core of income generating investments, realizing that now, in particular, short-term bonds yield a decent amount. And so I think having some income generation, but coupled with long-term growth and long-term growth from equities, I would not abandon the equity markets, even though a couple of weeks ago, it would have been really tempting to say, yeah, this is a little bit too much risk for me. I want the safety of bonds and cash. So I think having a balance between stocks and bonds is important. Not abandoning international stocks, which also is, I think, tempting right now, but there are some real values outside the U.S. So I encourage our clients and encourage investors to keep that balance between stocks and bonds. The biggest and most important caveat is, though, the worst things that can happen to your portfolio happen when you're a forced seller. And whether it's you're a forced seller because you don't have enough cash on hand to meet your immediate needs, or when you can't take the stress of being in the market, or if you're overly leveraged, if you've got too much debt. So avoiding being a forced seller in an environment like this is very important. And so we always recommend that people have a emergency fund, a reserve for known cash needs over the next 3, 6, 12 months, as well as a little bit of an emergency buffer for unanticipated expenses. If you've got that buffer, and that can be in the form of cash and short-term investments, if you have that buffer, you're less likely to be a forced seller, which I think is really, an important thing to avoid.
Yeah. Well, Dan, we've covered a lot of ground. Anything we missed or anything that just bears reemphasizing before we wrap up?
No, I think we've covered. I think we've covered the main things. I think it's important to just stay the course in your investment plan. Watch and read a judicious amount about the markets and about world affairs. But when you find that maybe you're getting a little overexposed, maybe it's time to turn the TV off, put the paper down, and go out and go for a walk in the sun.
All right. Dan, I want to thank you as always for sharing your knowledge and wisdom with our readers and viewers. It's greatly appreciated.
Thanks, Bob.